When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio. This is John Galt speaking. Sunned, tired, exhausted, and ready to rock and roll again as we bring back our team. We're going to bring six on in a little bit to sit there and discuss markets because God knows there has been a ton to discuss with markets. I'm going to hit a quick summary of the markets real quick before he goes on his tear, so to speak. I've got the Dow closing down 119 to 41,249, NASDAQ flat 17,928, S&P down 4 to 56.59, Russell 2000 down 4.5 to 2021. The week is over. Thank God for that. As of 20 minutes ago, I got gold up about $30 to 33.37. It did kiss 3,400. It's back. It's up. It's down. We're having the giant moves in it again because of the instability that's occurring with the trade war and the president instability. Silver finished the week up 32 cents today to 32.99. WTI up $1.11 to 61.02. Brent up 109 to 63.94. BTC or Bitcoin went insane and broke over 104,000. I've got it currently at, which I did not pull up, and I apologize for not having that chart up right away. For all you Bitcoiners out there, it is on a tear because, once again, everyone's trying to avoid the dollar, for lack of a better term. Bitcoin finished the day at 103,180, 10-year at 4.378, 2-year at 3.885, leaving the 210s at 0.49, 10-3 at 0.05. That's been all over the chart again. And the 5-year is, interestingly enough, kissing the $4% level on an almost regular basis now, which is a little bit disturbing. We are starting to see some deterioration in the belly of the curve going higher, and also with what's occurring overseas. People are trying to liquidate and really just get out of U.S. treasuries that are long dated because we really can't provide any kind of stable outlook for what the hell we're doing in this trade war. Side note, Swiss national debt once again has gone negative. And that is becoming a very entertaining feature when you look at markets because, let's face a quick reality check. Last time this happened, it did not end well for the euro. It did not end well for anyone. And it was a warning sign about the global economy. We are at that point again, and I think we'll continue to see that problem persist. It is definitely a headache that we have to address. And I think that we will see that happen as the tariff impact rolls into the greater economy. Real quick headline here. I'm going to read something from the website risks.net just to read you some of the headlines. What drove the Taiwan dollar surge? Foreign speculators, carrying wines, and central bank inaction. We saw a massive surge in the Taiwan dollar this week. We see Asian bond investors hesitant to buy the U.S. dip. We see volatility from the tariffs topping $1 billion in credit markets in Japan. We're seeing problems with the hedging strategies on FX. All of this is starting to roll into a bigger picture. You don't see it if you only watch equities. You've got to watch credit, folks. Credit is where it's going to happen. And with the quote unquote huge bigly meeting with Besant and the Chinese in Geneva this weekend, I thought it was very good as Geneva. Don't look for anything to really get resolved. It's another meeting about a meeting to discuss further meetings in all likelihood. And that is going to lead to more market instability. Let's talk about this real quick. I want to hit the credit thing domestically before I go back to the trade war, because it is going to roll into the trade war conclusion and consequences. Amanda Goodall had a very good thread reminding everyone about this. There are a ton of student loan borrowers that own close to $1.6 trillion in student loan debt, with 20% of them being 90 days or more delinquent. 195,000 government notices have been sent out. Folks, this is going to impact retail and the economy hard. The people who are getting these notices are getting their credit downgraded with the FICO scores being reduced are going to see reduced credit limits. They're going to see loans that could be called in some situations, especially if they're personal loans. HELOCs being impacted, the ability to buy a car or home being impacted. And in many cases, if you lose enough of your FICO score, some employers will not take a look at you. And that's just the reality of the situation. I don't think we can get that across to everyone. I think people need to understand that's going to impact later quarters, especially in the retail arena. And then Unicus Research came up with a fantastic thread. You might want to see what that is. It says at Unicus Research if you need to know what their handle is. This is important because this was the other shoe. We knew about subprime auto deterioration. However, now we're starting to see prime auto loan deterioration. Quote, Fitch expects an imminent rating downgrade. According to Fitch, some ABS pools are facing liquidity issues. Asset-backed security market is deteriorating. What are we talking about? The underlying asset values of mortgage-backed securities, automobile asset-backed securities, student loan ABS, and consumer credit ABS, both prime and subprime, are deteriorating, with some cases experiencing rapid deterioration. That's what happened last time we had a financial crisis, folks. You start seeing that kind of deterioration, bad things begin to occur, and that should be a red flag for everyone. Let's hit the trade war update, because the trade war is what everyone's paying attention to, and that's more of my field of expertise as far as logistics, etc. This is the ultimate insanity, what we're witnessing and what we're going to be putting up with. We've seen weekly spikes in the 1, 2, 3, 6 month part of the T-bill curve. Overnight, 1 to 3 hours, you'll see a 2-month shoot up 50 points, a 3-month shoot up 70 points, 60 points, 40 points, various times as someone in Asia is liquidating our T-bills to raise dollars rapidly, not using the borrowing facilities available by the Fed. So this is an outright sale and liquidation. And to be quite honest, I would not be shocked if Mr. Buffett and Berkshire had been one of the buyers of these cheap, of this credit that's been flooded onto the market, because it's a smart strategy. If you can get it cheap overnight, you go out and buy it in the billions. They want to pay, if they want to give it to you, or you can hold it domestically and pocket that 4.3 or 4.7%. My God, I don't see any reason why they wouldn't do that. So we're watching this occur, which tells us that we're seeing problems, not just in the Japanese insurers and banks, but it could be in other countries, as speculated earlier, in Taiwan. We have no hard evidence. It will be hard to piece together, but we're going to keep monitoring this for everyone. Meanwhile, in the trade war, people are ignoring it, and I'm going to bring Mr. Awesome on later on in the show. Building supplies are about to get very pricey. I was visiting a friend's shop this week, and I look at his lumber that he got in, his plywood, and he's a cabinet builder. He's a small guy, but he has a flat of plywood in, and it's made in Argentina this time. So we're trading more with Argentina versus Brazil, China, etc. But he's also been getting it from Spain, everywhere else, not Canada, not domestically. When you sit there and start to pinch builders and construction contractors, etc., on price, they're going to shop for the best price. Lumber is lumber. And at some point, President Trump's going to have to wake up to the reality. We cannot afford to have the cost increases in building supplies and even have a prayer of a recovery when this folds in on itself. That's where this is going to get expensive very, very quick. Meanwhile, in news today, Chinese exports jump 8.1%. I thought we shut them down. Tonight, it was announced, last night I should say, GM in Oshawa, Ontario, 700 layoffs, third shift is idled. By the way, most of the vehicles in Oshawa are exported back to Windsor and the United States. Congratulations. Toyota projects a 21% profit drop. Even though Toyota plays by the rules, builds the factories in the United States, unless they can bring their content level up to some of the absurd numbers that they're demanding in the trade war, Toyota may have to cut back on their investments in the United States. And that is what should be terrifying everyone. I came back from Mexico. I saw the BYDs, the Jettiors, all of the other vehicles that are coming in from China and other countries, including Japan. Suzukis are everywhere. We used to have them here. Quality, but cheap, affordable transportation, something the American people are dying for. But for some reason, instead of streamlining it for our auto manufacturers, we overregulate them. We put way too much. We're trying to make cars stupid proof now. Folks, I got news for you. You're never going to make a car stupid proof. We see too many of them wrapped around bridge embankments, semis, and street signs everywhere, knocked down by these clowns. It is an issue that we have to decide, are we going to be a nation of personal responsibility, or are we just going to make everything idiot proof and just move into the idiocracy thing and drink Brondo 24/7 and chug it like it's going out of style? Because that's the scary part. They want to treat everybody like an idiot. One last statement. Stephen Miller, the ace genius at the White House, came out with a statement this afternoon, and I about fell out of my chair. There is actual consideration of suspending habeas corpus for the purpose of expediting illegal aliens. Folks, we only do that during real times of war. They're going to use it under the provisions of an invasion. The day they suspend habeas corpus, everyone who disagrees with this White House, with the political agenda of those in charge, becomes an enemy of the state, if they so decide. Let that sink in. Without further ado, though, let's bring our friend Six. Six, are you there, sir?
Hey, John.
Welcome to the fun. I don't know how good it is to be back with the instability we're seeing in the markets. Everyone's touting the $6 trillion in gains that we've had, but this is one of the most hollow rallies that I've seen since 2007. Take it away and give us your opinion, sir.
Okay. Well, I mean, it's pretty clear at this point that the only thing that matters is what happens with the China deal. The China deal kind of sets the stage for the entire trade war at large. This weekend is huge. It's absolutely huge. Basically, the market is kind of pricing in. I believe it already has priced in kind of, tariffs to be mutually lowered by the U.S. and China to under 60%. The baseline expectation seems to be 50%. So that's in the price. We've been rallying off of that, off the lows for weeks. We've probably rallied back too far because unless the market is actually anticipating that by the end of the year, the tariffs on China and the tariffs on the rest of the world are going to go to zero. I mean, more multiple expansion is kind of ridiculous. We are already ES troughed at 48.32. Now it's 56.78. I mean, that's a whole bunch of multiple expansion back towards the top. We're not even that far off the peak anymore. We're down less than 10% from all-time highs with, some of the greatest headwinds that we've had in decades. But yet, despite that, markets are largely shrugging it off. There's a ton right now of positive expectations that are already baked into the price. I think that's very important. We've already priced in a very good resolution to this trade war. Credit spreads, I mean, they went up to, what was the peak, like 460 basis points. Now they've tightened back to 351 basis points on the high yield spread, which I mean is still near secularly tight credit spreads. So there's very little actual recession risk priced into the market, despite what, at least the credit markets, despite what the headlines you might read in the news.
Well, I'm going to interrupt you real quick. Moving on, outside of credit spreads, is the failure of the S&P to take 5680, 5700 range out with volume from a bull perspective somewhat disturbing?
Yeah, I mean, I think it's we've been trading in the range for all of May. Um, the So my big level on ES is 57.25. That's where we were trading at in July of 24, right before we kind of went into that growth scare meltdown, and then we bounced off the 200-day, and then just continued higher. Now we're below the 200-day. We're brushing right up against it. S&P is still a little bit off the 200-day. Nasdaq NDX is kind of sitting right under it. So I mean, I think the trade talks with China this weekend are going to be everything. I think that just like you were talking about on the China's export volumes, I mean, they're up, or at least they claim that they're up. But as far as I'm concerned, it says they're up. So they're clearly, despite what Trump says about how badly China wants to make a deal, I mean, it's been reported that we reached out first. We're the ones who need that deal. China does not really need that deal, and they especially don't need a deal that's not going to be good for them. And any kind of realistic deal with China.
Uh-oh, he just had a little bit of a belch there, and that means that his computer's giving him an issue. He's still here with us, folks, so bear with us. Yeah, one of the things that I was noticing on 06, can you hear me? Okay, he's not back yet.
Can you hear me?
You there? Yeah, now I can hear you. One of the obviously, because of what I follow, one of the more critical indexes I follow, the Dow Transports, which have provided no confirmation in this recent move at all. I mean, it's tanked. It's absolutely it's got above the 100-day moving average, but can't make it above the 50. Cratered below the 200 and still remains a good 1,700 points below, almost 1,700 points below it. So this is not the kind of indication of a bullish reversal in the long-term trend, in my opinion. What's your take on? I'm not going to go through Dow theory with anyone. That's just so abstract. It's very hard to do on radio. But it is an alert.
Yeah, as far, I mean, certainly it has to do with the ports. The ports are empty, are emptying. I have a friend. I mean, this is totally anecdotal, but I have a friend who works in freight brokerage, and their outlook and their internal sales guidance for this year is just horrible. I mean, our economy is very financialized and very tech heavy, so maybe there's an argument to be made that it's not as big of an indicator as it used to be, but I would be really hesitant to shrug it off entirely. But the way that this trade deal with China is ultimately going to settle, I believe, is that they're not going to give us the concessions that we ultimately Trump ultimately set out to achieve. They're probably not going to happen. We're moving towards China's manufacturing economy is absolutely booming, not just in terms of cheap labor, but in terms of skilled manufacturing. We're heading down a path at this point where I think that within a few years, maybe a decade, they're going to have better weapons production capabilities than us. They're going to have more scale at producing planes, ships, other advanced technology. Right now, we still obviously lead in intellectual property development, but now that they have kind of ripped us off with AI, they may accelerate in that area as well. So as much as they make it seem on the news that this is all about bringing jobs home, it's really, in my opinion, we're kind of starting to face an existential threat to our global dominance from China. And if we don't increase our manufacturing capabilities domestically, they're going to catch up to us and overtake us, because that's just the road we're going down right now.
Well, right now, unfortunately, because my personal strategy on this, and I've said it before, I'll say it again, was we should have sat there and isolated specific industries, made sure we had the reserves and ability to protect them with alternate suppliers, and then pick on China or India or whatever nation to cut the deals. This broad brush approach of everyone sucks, you better make a deal with me, I think is so insane beyond any description. And at the same time, we're trying to restructure our government and its regulatory structure for our economy for a quote unquote new era, but we're gutting some of the key regulatory oversight, which allowed the speculation that caused all the problems in 2000 and 2007. It's not a very good formula, in my opinion, and it does invite uh, historically market disasters of dramatic consequence.
I would definitely agree. And I mean, I think that their head was ultimately in the right place, but just the implementation has been totally botched. It's funny, we got into this kind of with what seems to be the goal of isolating China, and now we have merely isolated ourselves while I feel like every couple days I see them strike some kind of new trade deal that they didn't bully their way into. They just struck it on mutually beneficial terms. I feel like we've, if anything, strengthened their strategic position while weakening ours. I think that when they initially did these tariffs, they thought that I think they were a little bit delusional about having everyone run to the U.S. to make the best deal. If I'm another country right now, I'm waiting to see how it goes with other countries and how much they had to give up to get the tariffs gone, because obviously you're going to want to give up as little as possible. And I mean, the UK, the baseline tariff on the UK is still going to be 10%. And we don't even have a trade deficit with them. We have a trade surplus. So how's that going to shake out for countries that have deeper trade deficits? Probably not great. As far as volatility is almost back to the teens, which I think is ridiculous. There's just so much good news priced in. Inflation expectations have risen, especially in the short end. They're kind of stable in the long term. 5-year forwards troughed at 2.02. They're at 2.19 right now, which is lower than we started the year. So long end inflation expectations are not elevated. The last few CPI prints we've had and overall inflation prints we've had were positive. Inflation is continuing to move down. The tariffs are demand destructive, and it doesn't. The first quarter where we saw a pull forward in demand by ordering and getting business done ahead of these tariffs is kind of creating a little bit of smoke and mirrors, I believe, in the economy. And anecdotal evidence is never great, but I keep seeing consistent anecdotal evidence of slowdown. And I mean, you look at the economic surprise index, and it's been negative since February. We're consistently having downside surprises in the economic data. I mean, even if we don't go into a contraction, and I mean, they shrugged off the negative Q1 GDP print by attributing it to imports, but I mean, I feel like the signs are all there and they're just totally being ignored. I just can't believe that credit spreads are as tight as they are with so much clear risk mounting. There's just so much risk appetite. Bitcoin is surging, stocks are surging off the lows, credit is being gobbled up. Nobody that I don't know. This is a very interesting time, and I think that the downside risks right now are huge. Yeah.
But well, okay. There was finally CNBC covered it, which a lot of things happened while I was on vacation. I didn't even know there was a credit union failure until today, to be honest. About Americans buying groceries on buy now, pay later. If that's not a sign that there's a short-term credit bubble risk developing, and you should be looking at these junk bonds, I'm really beginning to wonder, because if consumers are having trouble making ends meet. At some point, the ability of these crap companies, no disrespect to the crap companies, they're going to start defaulting. And it's just a when, not an if. Now, in 2006, 2007, it took a year and a half to really snowball and start being noticed. But we're starting to see signs of, with reduced revenue reports, reduced forward projections, and reduced earnings projections. Is that when we're going to really start to see it in the third and fourth quarter as the inflationary spike for the short term from the tariffs is kept put into account, and then the deflationary aspects of tariffs rolls into the economy?
Yeah, I think, private credit is probably the perfect embodiment of this. Fitch just increased their default and delinquency projections. Delinquencies are rising meaningfully in private credit. I mean, I think the last figure I saw was somewhere in the 7%. And it's funny because I have asset management wholesalers absolutely blowing up my inbox trying to sell private credit funds to my clients, and there's just no way in hell. They're advertising, low teens returns with little risk, and the whole thing is just kind of delusional to me because, I mean, nobody pays 12% interest because they want to. It's because you have to. Those are not good loans. Um, I think there's a lot of junk that's been piled into these private assets, and that's probably a big pain point. We're seeing now endowments liquidating their private assets. I think that is a big pocket of the market that's going to have a reckoning this year, unless we see the administration just slash tariffs. There could be enough wealth effect carry through if they were to really let the animal spirits loose, which they're pretty loose right now, honestly. Bitcoin's over 100,000. The S&P's headed back towards the highs. Credit spreads are retightening. There's a ton of animal spirits back in the markets right now. Even with the Fed, and the other thing is the Fed is now hawkish again. They've said that they're not going to move. They said that they're going to be reactionary instead of proactive this time. So that is just one more hawkish impulse. But the front end of the curve is still pricing rate cuts. You have Z5 SOFR has sold off meaningfully. They've priced out basically 3 full rate cuts this year from the peak scare. But then you have Z6 SOFR, which is pricing in almost 100 basis points of rate cuts by the end of next year. So they're still pricing in rate cuts. The other interesting thing is the reaction from currencies. The dollar against the Swiss franc, even though the Swiss are cutting interest rates to negative, their currency still massively appreciated against the dollar as that went on. But it looks like it's troughed as of now. The yen has held pretty steady at 140, and now the Bank of Japan is easing off of their rate hiking ambitions with all of the uncertainty in global macro as a whole. What I'm very interested to see is if we do kind of stabilize, if they begin hiking again, because their bond yields continue to go up. Their 10-year has recovered most of the fall in its yield. The 30-year is now at new highs, and it has just been climbing for the past few years. So I mean, the path of rates in Japan, the interest rates themselves has gone up meaningfully, and if they hike again, I'm not sure how much powder is left in the carry trade in Japan, but you got to think that there's more. Let's see.
Well, let's hit the carry trade real quick, because you and I have both identified a critical level between 138 and 140 before we see a break below those levels in the end. I don't think the markets are prepared for the consequences of the liquidation that would occur. I think there would be a maximum exodus from equities and any risk asset at that point in time. That's part of the reason I think gold had these $100 days that we witnessed.
Yeah.
And why there was a flight to safety of the Swiss credit market, which is something you don't hear except for in times of extreme stress, because you're paying a very large amount of money for a very low yielding asset. Now, like you said, negative yielding asset. That has a consequence for investment houses. One more thing that I have to say, and I didn't want to interrupt you because you were on a good roll there. If private credit funds are opening it up to retail, that usually means they're in the deepest of trouble. Am I not correct?
I mean, yeah, they sell it to themselves for as long as they can, and then they need a new marginal buyer. Private asset investors have not been returned their capital. Well, at least private equity have not been returned their capital, and it's been a very public, well, not very, but it's been somewhat of a public thing that they're saying that they will not make new investments until their capital is returned. So now there's a big push to return their capital, and they have to sell it to somebody, so it's going to be retail. And as always, retail is going to hold the bag on that one.
Well, that's why we call them bag holders in a lovingly sort of way. So to all of you hoodies out there, don't take offense. There's a reason you're called bag holders, and it's usually at the end of a cycle. And usually when you said, how did the markets drop 30%? And what is a margin call? Why am I answering it? Real quick, before we go back to sticks and start getting sector specific, let's go through something that you need to know. MacroEdge.net/ozone, MacroEdge.net/ozone. Go there, sign up for your 2-week free trial. More available. We're working on some big projects in the future, and you can also look to subscribe for professionals to our monthly real estate update, including some of the great writers on the MacroEdge team. Don't miss it, folks. MacroEdge.net. 6. I'm going to hit you on some specifics here. Not specific, not stocks, individuals, but sectors. Right now, there's this myth that tech is invincible. I'm not so sure with China playing in the hard, long game with us. I think there's some major vulnerability, especially for the companies like Apple, NVIDIA, all these companies that invested heavily because they were told to in China and are now vulnerable because if we have a recession in the United States and they can't work or trade or do business in China, Europe isn't really exactly one of the most friendly places to deal with.
Yeah, I mean, these tech companies all have high valuations because they grow so rapidly. If you just take out the excess marginal growth, they have to reprice lower. I mean, history has shown that they're, if anything, more exposed to the business cycle than other firms. Let's look at the Mag 7 real quick. Where's that at? Okay, so the Mag 7 ETF MAGS peaked at the end of 24, middle of 24, at 58.69. It's at 47.89. So that's still meaningfully off the highs. That trade kind of got busted. They're still quite a ways from recovering there. Stuff going on.
Well, the Sox had a very weak bounce up off the 50-day moving average. It looks like it's getting ready to roll over again, looking at my charts.
Yeah, I mean, again, like it's just going to depend on what happens with China this weekend. There's a very rosy outcome that appears to already be priced into the market that both countries are going to bring tariffs down to 50%, and then after that, they're going to continue to work together to facilitate a positive outcome. But if those 50% tariffs stay on, that's not good. And we've already pulled forward all of this good news. And I think it concerns me because I was writing last night about how I think this is the China announcement is going to kind of be a sell the news event. But then I saw, even Bank of America is saying the same thing. So I'm not so sure I'm going to get that outcome anymore. But it really all comes down to what happens this weekend and how not just what the announcement is, but also the way that they frame the rhetoric. China is not happy with us, and for good reason. I mean, we've kind of kicked sand right in their eyes.
Well, one of the things, and for those of you who have never dealt with the Chinese, be it Taiwan, China, Japan, etc., if you offend them, they are not going to talk to you in the same terms that they were before the offense occurred. You have to come to them as a straight business person, straight eye to eye contact, handshake level, and deal with them straight on. Trust but verify your contracts with them, and they will do business with you. If you sit there and insult someone from East Asia or Southeast Asia, they take great offense to that, and they have taken great offense. And nationalism is a huge issue in China. We've crossed some lines that we shouldn't have crossed. And despite what the humor we find in the Truth Social postings or the Twitterverse, the Chinese people take great offense to some of the postings we've seen. And you have to have that mentality and understand that before going into these negotiations. Think that Scott Bessent's just going to go over there and kiss and make up.
Yeah, yeah, he's got his work cut out for him. It's a good thing for us that they sent Besant and not Lutnick, because that would have been a goddamn nightmare. Or worse yet, Navarro. Oh man, that would be an absolute disaster if they were allowed to participate in that. Yeah, I mean it's gonna be an interesting weekend for sure. The biggest thing I want to see to really get a gauge of where we stand against them is the United States imported 77% of our 2024 rare earth elements from China. And China has over 90% of the supply, and they have issued export controls on it. So if they lift the export controls on the rare earth elements, along with bringing down the tariffs, that probably signifies that tensions have been meaningfully lowered. But if those export controls stay on, that's the best barometer that I think that I can see to see where this is going. Are they continuing to trench in and prepare for longer geopolitical hostilities, or is it actually something that can be remedied over time and they lift the export controls and we kind of start doing business again while hashing out the details?
Well, let's take this British trade deal, the UK trade deal,
Yeah,
that we just had. Most people don't read it; they just look at the headlines and go, "Trade deal reached." As I wrote quite accurately, it was not a trade deal; it was a memorandum of understanding and a commitment to talk and hash out everything. One of the key aspects, though, that was left out of the MOU and not included is something that's a burr in the ass of high tech, and this is why Europe is hard to do business with for our high tech industry. There was no relief for the digital services tax. And I'm going to think that's a failure on the Trump administration to negotiate something meaningful. So we're going to import more Bentleys and crappy Jaguars, God knows why, and some tea, and maybe actually we'll get lucky, and they can reduce the price of my scotch. But in the long term, this is not a win. This is just a mediocre look at me. We've done something. And I think when markets start to understand that, it will cause a boomerang effect on equities. Your turn, sir.
Yeah, I mean, I totally agree. They were clearly so desperate to get something out as far as the trade deal goes. Congress is starting to turn against this trade war. I mean, rightfully. Um, I felt bad watching Besson get absolutely cooked by the Financial Services Committee. They were really hammering him. I bet he was not having a good time. When they asked him who pays the tariffs, for the first time I saw him really acting like a politician. Kind of hate that for him. But yeah, this is going to be an interesting year. The tax bill that they're trying to push through is, and they're framing it as some kind of stimulus. And I mean, I guess taxes not going up is somewhat stimulative, knowing that your forward taxes are not going to rise, but from current levels, it's no change. but then at the same time, you have a massive fiscal tightening in the form of increased taxes, but then you also probably have more spending. They're trying to raise the debt ceiling by $5 trillion, and I think that's another thing that's feeding into risk assets. And I've seen a lot of posts about this on Twitter. Is that nothing stops the fiscal train? It's never going to end. Which I mean, kind of looks to be the right take almost, because I was very optimistic about Doge when they started talking about that. I never thought that they were going to hit the levels of cuts that they initially said, $2 trillion. You know that that's ridiculous. There's just not, you can't cut $2 trillion without cutting entitlements. You'd have to cut entire allocations out of the budget to even get anywhere near that. Without touching entitlements, they can't cut the budget meaningfully. But I mean, the realized savings from that are almost non-existent, which is kind of depressing. So I mean, I can see the case for the long bond getting much steeper relative to the front of the curve. I wouldn't really touch long bonds. There's just so much negativity around that, which in a funny way might make it a great long. But as far as rates go,
well, real quick, you just made a statement that's fascinating, because it goes into my next discussion with you about long-term investment planning in this kind of environment. Basically, if you were to go into the long bond, you're assuming, as I am already, that at some point in the next 12 months, we're going to see massive quantitative easing intervene, because for Jay Powell it's not my problem, I'm out of here. Correct?
Well, I don't know. I think things would have to get pretty bad to see that happen. And I think before that happens, rates would go to zero before they would start quantitative easing. They'd probably introduce other liquidity facilities before they would do that. Different, 3-4 letter programs like the bank term funding program and things of that nature. But I mean, the most glaring trade that I can see is the front of the curve. It's sold off this week, and for the last couple weeks, but I think we're going to end up ultimately seeing much more rate cuts. I had a huge position in Z7 SOFR that I trimmed at 96.8. But I'm still long it, and I want to add back what I took off soon, but I really want to see how this weekend shakes out. I think they're inevitably, I think we're going to go over the next 2 years. I think we're going to go back under 2% on Fed funds. I feel pretty good about that. And I don't even think you need a deep recession to get there. But I don't think we're going to continue to run at 3% real GDP growth over the next 18 months. I think we're going to be sub 1.5 at best, at least this year, as all this plays out. There's so much uncertainty and so much paused investment, paused hiring plans. I talk to business owners all the time that are on the brink, if not already, of shedding workforce. They're just the expansionary elements to the economy cannot happen to the fullest when you have no idea what policy is going to be. Anybody who works in transportation, especially, how are you going to go out and hire a bunch of new people right now? You don't know what's going to happen. Like the shipping from China is just coming way down. I don't know how you can operate in that environment.
Well, that brings us to the long-term investing outlook, and by long-term, I mean 12 to 14 weeks at this point in time. I'm with you. I'm staying short-term. Full disclosure, not investing advice. Please seek a certified financial professional. I am in the short-term part of the market, the short part of the curve. I am not getting out of it with my retirement, which I hope to get. There's no way I would risk capital at this point in time in anything beyond a year. And I'll be brutally honest, as you know, I have gold. I'm a big gold bug, and there's a reason, as you just witnessed in the last 30 days. So, with that in mind, it seems to me that we're having a problem between either policy incompetence and economic nationalism overlapping, and that creates a higher risk profile than normal. And as I said before, with the asset-backed securities in the prime arena now becoming scrutinized by Fitch and other credit reporting agencies to follow, is that not the red flag that, hey, we better do something with credit before the year is out? Or do you really think they're going to sit there and extend and pretend until next year when the midterms come to risk?
I think that they're. If I'm a company right now who needs to raise money, I'm doing it right now while spreads are as narrow as they are. I'm absolutely trying to raise all the money that I need right now, because the risk you take is paying twice the spread in 6 months. Are you going to be greedy and hope they tighten further and things get better, or are you going to borrow as much as you can right now while you can? I would be inclined to borrow as much as I think that I need for a while, and see how everything shakes out. Which is another, which is actually, I mean, a tailwind for the economy if you're having net borrowing, but we also have financial conditions easing, and the credit spreads tightening. These are all tailwinds for the economy, but there are pockets of the economy that are very exposed right now. Travel plans, especially foreign inbound travel, is just cratering. The deportations and the nationalism at home just scares away foreign travel. So you have the travel that is taking a hit. I talked to business owners that work in hospitality that is not doing well. I talked to one manager of a regional chain that said that, and he doesn't really follow the news or anything, and he's like, I don't know what's happening. And since the beginning of April, our business revenues have dropped 20%, and we're probably going to have to lay people off soon if they don't pick up. I mean, I think there's probably a lot of that spread across the economy that it just takes some time to filter through. Just because we haven't seen it in the hard data to the extent that some people are expecting doesn't mean that it's not coming. It doesn't happen overnight.
Well, we have the 145% tariff cargo starting to hit next week. And I have the funny feeling that we're going to see a lot of it just stuffed into bonded warehouses on the prayer that those tariffs will be reduced. However, there does not seem to be an indication that anyone foresees a resolution this weekend or in the next 60 to 90 days. My concern sticks is, and I'm going to take this to the stock market again. If we don't have a resolution by the time the 90-day period has expired, we start seeing the higher tariffs on EU products also, Japan, South Korea, Taiwan, etc. I don't think markets are pricing in that risk factor. The idea that we can negotiate 50 major or 20 major trade deals at once with this crew should be of great concern, especially since they miscalculated the impacts on credit markets and equities with their broad stroke approach that they tried on April 2nd.
Yeah, I mean, I don't think there's a chance in hell that you're going to get much more than a lot of more of those memorandum of understandings passed through by that. You're certainly not going to get major trade deals. At least I don't think so. Like actual deals signed, sealed, and delivered deals. I'm not sure that Trump has the balls to actually reimpose those tariffs at the 90-day mark. I genuinely think that the bond market scared him when yields rose in 1 week the most in like 4 decades. He was close to getting Liz Truss. I mean, she made it what, like a week or 2 weeks? The bond market kicked her right out of office, and he's not bigger than the bond market either. I think that if you really saw those go full scale back across the board, bonds are nearly bidless again. So I'm just not sure that he has the resolution to do that. The market certainly is not expecting those tariffs to go back on. We would not be trading anywhere near here if the full reciprocal tariff rates were actually expected to go back into effect. But that said, like there's just so much complacency. There's so much positivity being priced in, and it's all been pulled forward. And nothing's really happened yet. We've definitely seen some de-escalation. The rhetoric is getting more business friendly. The Trump put on bonds. Sorry, that Besson kept talking about lower 10-year. They want lower 10-year. I haven't heard him say that in a while. Not to say that he hasn't, but I haven't heard him talk about lowering 10-year yields in a while. And now Trump is saying buy stocks, buy stocks. He said it near the bottom, and that was a prescient move considering that. He the next day he dropped, or maybe even the same day, I don't remember. He dropped the 90-day pause. Him saying it again yesterday ahead of lowering China tariffs is more interesting. I'm not sure. I wonder almost if there's going to be more than the market is expecting, and that's why he's saying that again, or if he's just thinking that lowering the tariffs on China is going to cause the same kind of bullish reaction. But that bullish reaction has already been experienced. The market is certainly expecting these tariffs to come down. So I don't think we're going to get very much more upside on it. Maybe you could break out of this out above 57.25 ES, but I don't think it goes very much higher than that. I don't think we're going to consolidate above the 200-day moving average, but on SPX. But if we did, I mean, you can't really be bearish above the 200-day after we just came out of that massive valley. I can't be bearish unless we're under it on equities.
What about a break staying below the 200, which it looks like we're going to, and back below the 50? I think there's 4 sectors that are toast this year, no matter what, because I don't see a resolution of the Chinese situation in time to save Christmas, and that's retail, transportation, vacation or casual leisure travel,
Yep.
and of course the big boy toys, optional or discretionary spending, boats, ATVs, RVs, etc. Anything requiring financing is going to be extremely unstable. Those 4 sectors are dead man walking. Period. End of conversation. Won't recover until 2026 if we're lucky. So we add any more sectors to that, and it looks like we're about to add the industrial sector with what I'm reading in the car business. The consequences of that are definitely recessionary without a question. And we are going to raise the debt limit into a recession and issue more credit at the same time. Back where I come from, being around in the late 70s, early 80s, and watching all that, that wasn't the best of formulas.
No.
My concern is what sector, if you have an opinion, do you think might be the next one to get a blindfold and a cigarette?
I think home builders have already taken it on the chin, but tariffs are just going to even further compress their margins. And with the Fed higher for longer on rates, like they can only manipulate so much interest rate buy downs and closing cost assistance for so long. Some of our real estate people here would have probably a more knowledgeable opinion on that than me, but I don't think home builders are going to have a good year. Airlines probably not either. Domestic manufacturing with higher input costs is going to be tough. There's really not a whole lot of places that are exempt from this. The areas of the market that don't have as much direct impact are the ones that trade at higher multiples that ultimately actually might take a bigger beating because of the reduced growth rates. Yeah.
Well, that brings us to the retirement of one Warren Buffett, and I haven't written my piece on this yet because I've been sort of busy this week, folks. If you only knew, but Mr. Buffett basically called out everyone who said he was wrong. He didn't do that directly, but in a professional manner, saying, "I'm accumulating cash for a reason." It seems to be a very sound strategy, even though you have the usual hucksters with loud jackets and Sharpies to sign boobs, proclaiming that the old man doesn't know what he's talking about. It's a new economy and a new era. At this point in time, holding the percentage of U.S. Treasury bills in circulation that he does, the old guy retired at a pretty damn good time and left that company in decent shape. What do you think?
Yeah, I mean, made another great market call selling off Apple. I find it very interesting that that the market drops 20%, the SPX, and he did not, he wasn't in the market making buys. He was buying, I mean, albeit in very small size relative to their balance sheet, Japanese brokers, which I find interesting because I do a fair amount of business with Macquarie Asset Management, and they just got acquired by Nomura in Japan, which is, I believe, their largest investment bank. So I wonder, if that might be a good place to think about being bullish. But then again, if BOJ hikes again, I would be much more cautious on that part of the world, investing in their equities for sure.
I totally understand that, Sticks, and I appreciate it. Now, listen, I'm going to hit you with one final question because that's how I play this game.
Yeah.
I know everyone says, why doesn't he just leak it to everybody in our chat so I can know what to answer? But here's your surprise question.
Okay.
Which of these three individuals gets a copy of the home game first, either resignation or termination? Besant, Lutnick, or Navarro?
Oh, Navarro. Actually, no, it's going to be Navarro. Vesson, I don't think it will be Vesson. Lutnick gasses up Trump too much for him to go. He's like the perfect hype man for somebody that Trump is all ego. Some of these other countries could settle this trade war just by sending a Statue of Liberty in the shape of Trump, and the tariffs would be gone forever. And yeah, Trump needs a hype man. It would be Navarro or Ron Ver, as he's locally called in his own mind.
So the first flunky to go will be Navarro, just because he's got to take the fall for the level of crisis we might see. Six, fill in everybody what you're doing at MacroEdge, what they can find out more, and about your writings, please.
So I do the MacroEdge Vision investment research. We put out research reports on what we think to be very asymmetric parts of the market, like the most asymmetric trades on the board that are being seen at the time, at least in my eyes, and the overall.
.net/ozone, macroedge.net/ozone. You can find out more there. Get your 2-week free trial. Check out the writings. Check out the other information that's available, including our real estate reports and future plans, which are getting bigger by the day. Let me just close this out by saying that the old man at age 94 retired in a very prescient time and manner. And you're going to hear a lot of people say he didn't know what he was talking about, etc. But one thing for sure, I'm going to make a wager that the net worth of everybody in this chat room, hell, on X, except for Elon, is not $347 billion cash. And the difference between liquidity and net worth is massive. The man is liquid. The man can make acquisitions. The one thing that surprises me is that he didn't make one purchase. We have exactly one active lithium mine in the United States. It's the Albemarle Silver Peak mine. We don't have any other lithium mines at this point in time. And you would think that with Elon Musk and everybody screaming about EVs and rechargeable batteries, et cetera, we would make it a strategic national imperative. Folks, when you see Berkshire get involved in that, that's when it's going to become serious. Unfortunately, at this point in time, we're not a serious nation. We're not a serious equity or bond market. I think we're at one of the greatest risk periods in the last 100 years. And it is sort of weird how every 20 to 80 years we have a massive downturn during an economic reset as the economy shifts, be it from agricultural to industrial, industrial to tech, tech to internet, and internet to God help us when the robots pick up everything for us and pick out our equities. For MacroEdge.net, this is John Galt speaking. We will see you next week. 6, thank you again for this great show, and good night now.